Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And before we get started with today's show, and I bring in my very special guest, who you guys can already see here, and many of you already know him. I just want to let you know, if you haven't done so already, this is a live show that we record every Tuesday. So make sure to go to passiveinvestingwithwhitney.com. There you can get access to all of our masterclass registrations, our bootcamp registrations. You can schedule time with me. We can talk all things passive real estate, and you can get on our list to see our live deals, our open deals. And again, that's passiveinvestingwithwhitney.com. All right, today I am so excited to be joined by Yonah Weiss. Yonah is the business director of Madison Specs. He's been on before to talk to us about bonus depreciation, which was almost a year ago. I can't believe that. But here we're going to talk about something else, the cost segregation, which is like 3 steps before the bonus depreciation. Yonah, before we dive into that topic here today, would you let the audience know a little bit about you and how you got to where you're at today?
Sure, absolutely. And first of all, thank you again for having, well, not again, but thank you for having me again, is what I meant to say on the show. It's a pleasure. Love everything that you guys do at passiveinvesting.com. A little bit about me. I am besides for cost segregation expert, I am a father to 6 kids. I was a teacher for about 15 years, but honestly, I continue to teach every day, even in the real estate world. So, and I know you do the same, Whitney, so I know you can relate to this. It's just a lot of fun for me to be passionate about a topic, passionate about something, and then being able to share that wisdom and teach other people to maximize that. So I got involved in real estate about 8 years ago through many different channels. I went through different stages, from being a commercial mortgage broker to doing some fix and flips, being a residential broker. Eventually, I found my way to this great company, Madison Commercial Real Estate Services. Madison Specs is a division. It's the largest national cost segregation company. And you may be asking yourself right now, what the heck is cost segregation? Don't worry, we're going to talk about that. But it was, it really came to me through that teaching background that, just like you listening to this, most people that I spoke to had no idea what this thing, cost segregation, was. And so it really gave me the opportunity to just educate people about what this is. And obviously, it's, once you know what it is, it's like a no-brainer. Like, either it's works well, it's an amazing tax strategy for real estate investors, for property owners. Sometimes it works, sometimes it doesn't, meaning it may not be the right fit for every single strategy, but it's important to know so many of these kind of tools in your toolbox when it comes to real estate investing.
Well, let's dive in. Okay, so I always like starting, teacher to teacher, right? Like, what is it we're talking about? Let's define that, and then I want to kind of get into like how we started applying it to different real estate asset classes, and then how it can benefit passive real estate investors. But let's start first. What is a cost segregation study? Like, how does this work?
Yeah, it's actually taking even a further step back to understand what depreciation is, because cost segregation is just a form of depreciation. It's an advanced form of depreciation, which in of itself is kind of a confusing word because it sounds negative. It sounds like something's going down in value, when in fact, it's just the name. It's a borrowed term. It's the name of a tax deduction. Okay. And yes, it's based on the principle that things go down in value as time goes on. But even if you buy a property, it doesn't matter how long it's been around for. It could be built in 1920. When you buy a property, you get to start depreciating that property, meaning you get to write off the entire value of that property based on your purchase price, okay? Not on the intrinsic value of the property. And it's over a long period of time, over a 27.5 or 39-year period, which is a long time to really write off a property. Meaning, if you just take the purchase price, divide it by 27.5, it's a little bit, it's about 2 to 3% a year. And that's called depreciation. Okay, again, just a borrowed term. What cost segregation is, just taking it to the next step, is if you think about, and forget the word cost segregation, two words for a second, because it's weird and it's kind of confusing, but it used to be called component depreciation. Okay, so what we're doing is we are breaking down a property into its individual components and saying this structure may depreciate over a long period of time, but the IRS says there are certain components that actually depreciate over a faster period of time, like a 5 or 15-year schedule. And so what we're doing is segregating that cost. We're breaking down that original purchase price into these different categories, these different buckets, if you will, where you can now take the depreciation deduction of these assets or of these components at a faster rate. So essentially, I mean, to just kind of recap that in simple words in one sentence, it's a cash flow mechanism that allows you to get bigger tax deductions in the earlier years of ownership by breaking down the components of a property into different depreciation schedules. That sounds more confusing than it did in my head.
Well, so I have an example for that, right? I am in the middle of redoing the floors for our house. And now okay, but let's just set it aside. This is my primary residence, but like just for the illustration, let's say this was a rental. My floors only lasted, in this case, 15 years. I got a kid, I got a dog, and, we've had people renting the property off and on throughout the years. They broke down, they needed to be replaced, but the foundation of the house is still fine, right? So what I hear you say when you do something like this, component depreciation, certain components are going to break down faster just because of the very nature they wear out, whereas other components on the property, don't break down as fast, so you can't write them off as quickly.
Yeah,
Now,
that's exactly right.
I have a question for you here. Why does the IRS even allow us to take depreciation? What's the advantage to getting this write-off?
So what's the advantage from their perspective? Why would they give it? I think, I learned this from Tom Wheelwright's book, Tax-Free Wealth. So if you guys haven't checked that out, from the Rich Dad Advisor, Tom Wheelwright, he said that the tax code is really an incentive program. Okay, meaning the government wants people to do certain activities to help spur the economy. And in doing so, they give tax deductions and tax breaks to help doing that. So real estate is one of those things that it really does help to spur the economy. People need housing, right? Even if you're not talking about residential, right? Businesses need to function, right? Retail, office, whatever it is, you need these type of assets. And so therefore, by giving this, this tax deduction, actually incentivize people to buy more properties, to reinvest, to invest. And at the same time, logically speaking, things do, wear and tear, like you said, right? The carpeting or the flooring, right? The roof, these things do wear and tear. And so they need to be replaced. And so by giving you this deduction at the onset, right? Or over a period of time, it actually allows people to continue, right, the upkeep of the property because they've had these kind of deductions to help, continue investing into the property.
Okay. Well,
so that's the logic, at least I think.
Well, it sounds reasonable, right? And just through continued, cost segregation or component depreciation, it's not anything new. It's been around for quite some time, and so the IRS, they want us as investors to keep these properties in repair because we're solving a housing issue, we're solving a business sheltering issue, whatever it might be. They don't want to get into the weeds of having to figure out how to keep homes in repair. Make the investor do that, right? Like they're the ones benefiting from the asset. That's the kind of how I wrap my head around that. So let's talk about it. What types of property qualify for a cost segregation study? And does a passive deal count?
Yeah, well, any type of property really does qualify, except for, as you mentioned in the example, your primary residence. So you cannot depreciate your primary residence. You can't take the tax deduction but for any business or investment property, you're able to take depreciation, which allows you to do cost segregation as well. Now, there are certain properties that are better than others, meaning there's going to be more components that depreciate faster in certain types of properties. For example, think about like a short-term rental, for example, where you're going to have a lot of furnishings, a lot of appliances, a lot of things. All of those depreciate on a 5-year schedule. Anything that's non-structural, that's in the inside. So again, like things like appliances, furniture, cabinets, countertops, right? Even wall coverings, things like that, flooring, if it's plank or carpeting or LVP, vinyl, all of that depreciates faster, and many other things, window treatments, etc. Think about things that are non-structural. So structural things would be like the roof, the walls, foundation, doors, windows, infrastructure, but almost everything else. And you wouldn't even think like so many things do, like millwork or things like, lighting and things like that. You wouldn't think that depreciates faster over a 5-year schedule is considered personal property, non-structural, but it does, it does, and it is. So to answer your second question about can this be done on passive investing as well? And the answer is yes, absolutely. Because as a passive investor, in most cases, and it's important to understand your investment, understand the documents, et cetera, but in most cases, the depreciation is passed along to the investors as partial owners in a property. Okay. So if you invest, you're essentially getting a portion of the equity of that property, of that deal, and therefore you are given or allocated depreciation according to your percentage of ownership. So just keep a simple example. Let's say 10 people invest in a property, each one put in $100,000 and they bought a property for $1 million, all cash. So I'm going to tell you why. I'll give the same example with debt and financing, and you'll see how the difference makes when it's debt. Because again, depreciation is based on the purchase price, not necessarily on how much money was put in. But just keep it simple. If everyone put in $100,000, they're able to take, each one is going to get 10% of the depreciation at the end of the year. Okay, so in a classic example of depreciation where we're taking, let's say, 25% of the purchase price as accelerated depreciation, then you're able to get $250,000 of depreciation in the first year. And that was with 100% bonus depreciation. I'm not going to get into too much. We're going to talk about that a little bit. And we did a previous seminar talking all about bonus depreciation. This year it's 80%, but just to keep the numbers round, you can see that each person who put in $100,000 is going to get back 10% of that deduction. Now, that's $250,000 divided by 10, $25,000. Essentially, they're getting 25% of their investment back as a tax deduction in the first year, which is great because they're probably not making, 25% return, which means their entire income is sheltered from taxes. And so that's great. But if you use the same example by using debt, and let's say it's a 75% loan and you're putting 25% in, the same people put in $100,000, but instead of buying $1 million property with a 75% loan, you're able to buy a $4 million property, right? Put down $1 million and the 25% down payment, you're able to buy a $4 million property, which is crazy if you think about it. That's the power of leverage. And not only are you getting more cash flow from that higher, valued property, but now the 25% of the bonus depreciation is now not $250,000, but it's $1 million, which means everyone is going to be getting 100% of their investment, $100,000 tax deduction in the first year, basically 100% of their investment. So that's just kind of showing you basic numbers. Obviously, it will change and vary based on what the allocation is, what the LTV, what the loan to value is.
Now, I think you just blew a lot of people's minds when they hear depreciation. I sheltered income. I got my investment back. Maybe I know for me, like initially I was like, I didn't get a check back in my pocket. Like, where does this all land? When you say I got my investment back, where does it land and how do I get to use it? I know you're not an accountant, so.
Right.
Well,
it's an important question.
Put the disclaimer in there.
No, absolutely. And it is a really important question because a lot of people think, oh, I guess if I get this depreciation, I can just use this, to do anything. Well, against any income. And that's not the case. So it is important to know how this works and check with your accountant. But essentially, in simple terms, real estate is taxed differently than ordinary income. Okay. So real estate, any income that comes from rental properties or real estate is considered passive income. Now, it may not be passive. Now, we're talking about passiveinvesting.com. So hopefully people on this webinar are investing passively, but the IRS considers income from real estate considered passive regardless of whether you spend a lot of time doing it or not. That being said, the depreciation can only be used to offset passive income. Okay, so you're only going to be able to use the depreciation from your cost segregation to offset or to lower your taxable income from your properties, from your investments. Now, that can be across multiple investments. It can be, you have 100 properties. the depreciation from one can offset the income from all of them. Okay, so they're in different buckets of taxation. However, there are a few exceptions to that rule. So generally speaking, right, if you're a high paid W-2 or whatever, you're thinking, oh, I'm going to invest in real estate and pay no taxes, right? It's not the case. Unfortunately, it usually is not the case. There are a couple exceptions, but generally speaking, depreciation and cost segregation can only be used to offset your passive income.
So like if somebody is really, or an investor is really curious to understand, okay, if I go in this passive deal or even an active deal, something that they purchased themselves, and I perform this cost segregation study, they want to understand the impact on their own tax liability for the year. They need to sit down with their accountant to fully understand what can they take now, what gets suspended. And here's the thing, it's not, and I spend a lot of time talking to investors about this. They're like, oh, I can't use these depreciative losses, so it's all mute. They're gone. They're not gone. They suspend on your tax form. So this is, brings up two questions, or not two questions, two comments. One, make sure to work with an accountant and work with an accountant that fully understands real estate, because they need to be able to book this all properly. I've seen people not have their depreciation booked properly, and it's kind of, it gets a little icky if it wasn't carried forward properly. But this leads me into my next question. How does the cost segregation affect property disposition in capital gains?
Excellent question. And so, the first question I'll just touch on for a second, because I think it's a really important point. It's going to be, and maybe we'll come back to some of the exceptions to the rule, because there are ways that you can get around this or realize some of these benefits, even if you're, a high paid W-2 or whatever, but we'll get to that in a second. But to answer the first question is really, yes, it's going to pass through to your K1, it's going to pass through to your, and help to offset that income from other properties as well. And in terms of the gain, yes, it's actually passive deductions, where this depreciation can not only be used to offset that passive income. I mentioned before, it's kind of limited to just passive income, but it's also can be used to offset passive gains. So from the sale of real estate, not the sale of other things, but from the sale of real estate, you are actually able to use depreciation to offset the capital gain tax or the depreciation recapture tax, which is really important, because if you think about it, you may have this huge kind of loss, what you said, like these suspended passive losses that just get carried over on your tax, like this imaginary bank account holding this, all this money, and it's just sitting there. And you can use a little bit every year, but unless you're a real estate professional, you can't use all of it. Once you sell a property, those losses get released and can help reduce the taxable income from the gain, from the sale of that property, or any other gains for that matter.
And this is where, again, not an accountant, but I would, refer people back to, the episode that I did on the lazy 1031 exchange. And I go through an example there where I actually tried to start pulling off a 1031 exchange. Now we're adding in another complex tax term. So we'll stick a pin in that, and we'll do another episode on that later. But I had performed a cost segregation analysis on one of my short-term rentals. Okay, so the losses were sitting there in that account, and I was trying to pull off this other 1031 exchange with multiple long-term rentals that I was selling. Couldn't find a suitable replacement asset. So, I go to my accountant and I say, hey, like, what's my tax liability? And she was like, you remember those golden bucket of losses that we built up over time from your various passive investments and the cost segregation study that we did on that short-term rental? I'm like, yeah. She was like, you don't have any. It wiped it out. And I'm like, that is the beauty and the power of real estate. Now, right. It doesn't. Now that bucket of losses isn't there, so I either have to continue to replenish it or start paying tax over time, but I can't wrap my head around of any other asset class that that a normal person can access that can give that type of time value velocity of money like the depreciation can. Like, I think I've heard you referred to it before as a tax shelter. Depreciation is a tax shelter.
Right. And it's amazing when you think about this, you kind of stumbled upon that accidentally almost, right? With your accountant telling you, about that, but think about the power of this. If you can plan this accordingly, how much more you can do, because you won't have that tax bill. You can actually, a lot of people have like, set aside money to, pay taxes or the prepaying the tax, whatever it is, and they have a large amount. Well, what if you knew in advance that you wouldn't have that tax bill? Then you could use that money to reinvest and, buy other properties and make more money, et cetera, and just kind of keep it flowing.
Yeah, and I will say that we did plan a little bit, but I was expecting a tax bill, and when she told me I had zero, I was like, okay, here we go. Well, okay, so are there any potential IRS risks, audit risk associated with performing a cost segregation on a property?
So no, none whatsoever, because cost segregation is actually considered by the IRS the correct way to depreciate your property, which is amazing if you think about it, meaning they want you to break down the depreciation into these different categories of 5 and 15 and 27 and a half year, which they don't require, because that would, require you to pay for a study to get done, which is like an extra expense. So they don't require you to do that. Also, I think they understand that if you don't do this, then they'll just end up making more money, right? They'll get more revenue by people overpaying in taxes when they actually don't have to. So it's important to kind of plan ahead to know this, but yeah, definitely no audit risk whatsoever. I think the only thing to be cognizant of is make sure that if you do end up getting a cost segregation study done, make sure it's done properly and with, people with credentials and people that know what they're doing, and not just kind of figuring out and trying to do it on your own or something like that, because that would not have an audit risk in terms of flagging it for an audit. But if one were ever to be audited, it wouldn't hold up. And so you want to make sure that you are hiring a company that will stand behind their work and obviously has experience with that.
Well, let's talk about how do I choose a qualified cost segregation specialist?
Well, he has to have a long beard, and no, I'm just kidding. That's one of the qualifications, obviously. No, I mean,
you raise your hand.
You want to make sure that they have a lot of experience. They've been in business for a while. They support the audit protection. Like I said, they're following what's called the Cost Segregation Audit Techniques Guide from the IRS. So it's a very detailed, like 300-page document just detailing of how this process is supposed to be done. The studies themselves can be, 80, 90, 100 pages long, which are very detailed, because the IRS has this, I don't know, they have like this wish that everything has to be so detailed and tedious that, everything that you do has to go into that depth. So yeah, you want to make sure that I think that's the most important thing. There's no specific like qualification, like a certification or anything like that for cost segregation, besides for CPA, right? Meaning a CPA must sign off on the cost segregation study. So which means the company that's doing it has to be run or led by a team of CPAs. So it's not just like, an engineer, which is part of the component of a cost segregation study, is having that engineering component where engineers are coming and breaking down the components, but you also have that accounting component. So you have to have a CPA who has that credential sign off on it.
Well, are there any potential limitations or drawbacks of doing a cost segregation study? Is there anything, that people should consider before, like, actually pursuing getting one?
The main thing you want to see is, to what the benefit. People are always curious, like, well, is this going to be beneficial or is it not? Like, and so one thing that we always love to do is to run a free upfront analysis. So we're able to show, before you do anything, we're able to show what the potential tax savings are going to be. And so, already ahead of time, if you're going to be saving money, how much money you're going to be saving, what it's going to cost, et cetera. And so that's the most important thing. The other things, just to know ahead of time, and this may seem like, just so simple and straightforward. Unfortunately, it's not, is that make sure that your CPA or whoever's doing your taxes also understands this and knows how to apply it. Because believe it or not, I've had countless literally times where CPAs have just not been familiar with this, or don't know the intricacies and don't know, things about the real estate professional status, which we didn't even talk about yet. But these are things that everyone needs to know And, unfortunately, not all accountants specialize in real estate. And so make sure if you're looking to get a conservation study, find a CPA who understands it and knows real estate, unless they're the ones that are suggesting it, in which case that's, that's a great thing to have someone on your team like that.
That's a good thing. Well, before we wrap up, I know we have several questions coming in, and I want to make sure we save time for our Ask Me Anything session of the show for those people who are attending live. I have 3 more questions for you, but one is you've mentioned real estate professional status a couple different times. What do you want the listeners to know about that?
So we mentioned before that all depreciation and conservation is limited to offset passive income or passive gains. And I mentioned before, and I alluded to, that there are a few exceptions to that rule. The most notable exception is this thing called real estate professional status. And this is a definition by the IRS, which says that if you or your spouse, only one of you needs to have this qualification. If you or your spouse qualifies as this, then you don't have that limitation, meaning you can use cost segregation to offset your active or your W-2 or any other source of income that you have. Again, it's no longer limited to just offset your passive income. So that's huge, because if you think about someone who has a higher W-2 and they have a lot of income coming in, or one spouse does and the other one is a real estate professional, you can potentially use this strategy to pay little to no taxes whatsoever. So now, what is a real estate professional, right? It's essentially 2 qualifications, and both of them need to be met. Number one, you need to spend more than half of your working hours during that year. And this is looked at on a year-by-year basis. So it's not like you don't need a real estate license. You don't need, any sort of credentials to become a real estate professional. It's just literally writing that as your occupation on your tax return. But once you do that, you have this, like golden ticket that allows you to use the depreciation to offset active income. So again, number one is more than 50% of your working hours have to be in the real estate trader business. So being a broker, active managing, acquiring, whatever it is that you are doing, that has to be the majority of your time. And the second qualification is you have to spend a minimum of 750 hours a year. So you don't have to, be full-time, meaning you could potentially have another part-time job, but you can't also, on the flip side, you can't just retire and, just be doing nothing and not working at all and also have the real estate professional status. You actually have to be what's called materially participating in these real estate trader business. So that's what you need to know. That's the most notable exception to those passive activity rules.
All right. And so the natural question I get from investors, and I'll take the field on answering this. They're like, oh my gosh, if I'm going to do this all passively, I got to become a real estate professional too at the same time? No, you don't. Why is that? We've come full circle is because now you have these depreciative losses that are sheltering your income. So that's one of the beauties of passive real estate. That would be for me the kind of the other way to sidestep, or unlock that depreciation. If all of your income is coming from a passive source like real estate, and maybe it's not even passive deals, but you have own all your own multifamily or all your own self-storage, guess what? The depreciation should be sheltering that income. Yonah, what do you want people to walk away with from this episode? What is the most important thing that they should be taking away from this episode?
So many things. I think number one important thing is continue your education, right? Continue going to webinars like this so you can learn about all of these different nuances and these different strategies with regard to real estate investing, because this is just one, right? We're talking about cost segregation. We, talk for a couple hours on this one specific topic, and you still wouldn't know, half of it. And that's important because there are so many of these, like I said, strategies. So that's the number one thing. Continue learning, never stop learning, because there's so much to know, and hopefully applying that and just increasing your income through that. The second thing I really want everyone to understand is make sure that you have a CPA. If you are a real estate investor, you want to make sure, especially if you're trying to be a real estate professional, make sure that you have an accountant who is also, understands real estate and is on board with those type of things as well.
Sage words. Yonah, how can people find out more about you and understand if they own their own real estate, if doing a cost segregation is right for them?
Yeah, I mean, the best thing to do, like I said, is to get a free upfront analysis where you can see the potential tax savings. So you can find me. I'm on all the socials. You can also go to our website, Madison Specs. You can check me out on yonahweiss.com. That's my personal website. Talking not just about the cost segregation, but also my podcast, Weiss Advice, which we had Whitney as a guest on that not too long ago. And yeah, like I said, please reach out to me on LinkedIn, Facebook, Instagram, Twitter, but on one condition. Don't just hit that follow button, right? Put a little note, take 5 seconds and write, hey, great presentation, or I didn't like your presentation, whatever you want to say. Just say something, right? Don't just hit the follow button, because I want to know, who everyone is and how you found me.
And feedback is king. I mean, that is how we, provide better and better content, is whenever we get that feedback. I agree on it. And, for those of you people who are, investors who are alive and are learning, taking the time to learn about the cost segregation, how it might apply to you, and you're scratching your head to go, do I need one or not? Like, I'm in a passive deal. Do I need to get a cost segregation specialist? Your operator that's running that deal, we do this here at passiveinvesting.com. They are the ones that are actually working with groups like Yonah's group in order to perform the cost segregation on your behalf. So yeah, just another perk of investing passively. Because that's another team member you don't have to find. Well, Yonah, thank you so much for your time here today. We're not going anywhere. We're just going to stop the live portion of our show. Again, thank you for spending your time and imparting your expertise with us. And for those of you here live, don't go anywhere. And for everybody else, we will see you next week.